everybody. Welcome to the ICBSS, International Center for Black Sea Studies and Black Sea Trade and Development Bank webinar on the post-pandemic recovery in the Black Sea economies. We're very pleased that you can be with us today virtually for this important discussion. It's a topic, of course, that is very prominent in the news, much discussed all over the world. We are giving it a particular focus today, looking at the greater Black Sea region, and we're very fortunate to have a distinguished panel of speakers who will help us to understand what is going on, how the pandemic has impacted the region, some of the measures taken to counter it, what are some of the challenges that are being faced as we go forward, the risks that we see, the unintended consequences that might come out, and so on. Further ado, I will turn over to the president of the Black Sea Trade and Development Bank at my side here, Mr. Dmitry Pankin, to say a few words, and we'll get the show started.
Well, good morning, dear colleagues. It's very nice to see you. And for us, I think it's very interesting to run this seminar, because I think development bank should not only be a source of cheap money, but it should be kind of knowledge-based institution, and we are very glad to offer our platform to change view about situation in our countries, in our region, some forecasts of what we have now. Maybe just for introduction, a couple of words. Okay, for me, I'm not very young person, so I had a lot of crisis in my life. And you see, in each crisis, I had the impression that, okay, now we are living in a new world after crisis, so all structure will be changed, so everything will be changed, but steadily things are coming more or less the same. So first expectation maybe during crisis a little bit exaggerated. And after crisis, again, there is some, let's say, comeback situation. Second, maybe if I'm looking on our bank, what we have now, what is the experience with our client? Frankly speaking, my expectation again was much worse. We expected that we had a much more problem with our clients. Now I could see that I cannot say that we have no problem, but if it was some problem with client, now this problem are worse. But still, it's not kind of big, serious situation. We don't need to change our forecast. We don't need to change our budget. So more or less, we are okay with the situation with our client. Again, maybe we are not dealing with whole spectrum of economy, but again, what I'm speaking about, financial institution, infrastructure project, so more or less okay. And finally, third point, I think what's worried me now, and what's I think very interesting situation, this is the situation with the liquidity. All markets are flooded by liquidity provided by European Central Bank, by Federal Reserve System. And of course, there is no such a flexibility in this market, so liquidity is not reaching all clients. And what we see now, if right now bank is going to a market, we are borrowing money, and what we see that now rating is not so important. So much more important if we are European institution and we have access to European Central Bank money. This is much more important than to have a rating. And we have big distortion if we have the same rating as that company. So our rate of borrowing could be dramatically different, because again, one company has access to European Central Bank money and other company has no access. So I think this development is very interesting. And again, this situation of excess of liquidity, of negative interest rate from a macroeconomic point of view will be interesting to see how it will go further. It looks like kind of taxation on the wealth and redistribution of wealth between generation maybe. So I think from macroeconomic point of view, situation with the interest rate and negative interest rate is very interesting. So I will give the floor to Panos to lead our discussion.
Thank you, President. I think we hit the ground running. Without further ado, I will ask our keynote speaker for today, who has a long and distinguished career going back to his role in government as a deputy minister in the government of Georgia, has worked as a journalist, has worked as a senior economist at the IMF, and currently since 2016 has served as the governor of the National Bank of Georgia. Could I ask you, Mr. Kobak Venetadze, to take the floor and continue as we have. Just let me say one thing for our audience, our participants. You will be able to ask questions in writing. You are welcome to do so. We encourage you to do so. They can be either general to all the panel or specific. Please do so in writing. There's an opportunity, there's a way to do that. And then we will try to get to them after the keynote address and the comments of the panelists. Thank you.
Thank you very much. Mr. Pankin, dear participants, I'm delighted that I was invited today at this panel. Let me, in my 15-minute speech, highlight how we see the problems which were brought by pandemic, what we have been taking in Georgia, and what I see as a main issue for the region to deal with during this pandemic. Well, we all know that it's unprecedented shock, which is challenging all sectors of the economy and creating a high degree of uncertainty about economic outlook. And as a part of our mandate from the onset, we took measures, of course, many measures. Mr. Pankin also noted the issue with liquidity, so Georgia was not unique either. Pandemic has led to a significant increase in demand for liquidity of the national currency, and it had to be addressed very quickly. With the increased demand for this liquidity, we saw an increase in market interest rates due to higher liquidity risks perceived by the financial institutions, and in the situation, higher interest rates don't help at all to economic recovery. In order to eliminate liquidity risks, we started providing sufficient liquidity of the national currency. We started to banks and microfinance institutions through foreign exchange swap operations. By the way, we started to supervise microfinance institutions back in 2018. We made them much healthier, and it enabled us to provide liquidity to this very important sector, which provides financial resources to rural areas, and which is very important for Georgia. At the same time, market was still very nervous. They were not just satisfied with this. So we decided to introduce a standby swap facility that enables banks to get unlimited liquidity with corresponding foreign exchange currency collateral with penalty rate. And it really is the situation because the banks know that they can access liquidity. Starting on June 1st, we introduced new instruments to support small and medium enterprises lending, of course, through commercial banks and microfinance institutions. This SME liquidity support consists of two components. The first is for commercial banks, which have the opportunity to receive liquidity support from the NBG against the collateral of SME loan portfolio. And second tool is for microfinance institutions, which enables to attract funding from commercial banks with the support of the National Bank of Georgia within the predefined limits. At the same time, at the onset of the crisis, we developed and announced and explained a temporary supervision plan that is in full compliance with recommendations by International Monetary Fund, the ECB, some other institutions. It is important to note that Georgia's banking sector was very healthy. It had sufficient capital and liquidity buffers, and these buffers have been gradually accumulated in Georgia through the supervision of the National Bank of Georgia. And this very healthy situation enabled commercial banks and microfinance institutions to propose a payment holiday to all of its clients for 3 months, for the duration of 3 months. And about 50% of the borrowers, a bit more than 50% borrowers, use this opportunity. So you can imagine how much relief it was for them in this difficult situation. So as a part of our plan, we released conservation buffers, we released Pillar 2 buffers, and we allowed the banking sector to neutralize potential losses. But at the same time, we monitor current events, we are in constant communication with the financial sector. Every week we have a meeting with commercial banks and with microfinance institutions to understand if there are any issues here. And if due reduced economic activity and difficulties caused by pandemic, the share of non-performing loans and credit losses will increase more than it is expected, then we will launch other instruments to take additional decisive measures. Moreover, at the onset of this crisis, the banking sector in Georgia made significant loan loss reserves for potential losses due to worsened expectations. So even these losses were not realized, we decided that we have to do this provision. And it made the sector even more confident. So keeping the financial intermediaries healthy and robust within sufficient capital and liquidity is always crucially important. So now let's talk about some other issues. In addition to the pandemic lockdown causes a recession, it also reduces income unevenly throughout the society. There is an essential and necessary role for fiscal policy to play. The measures that the government is undertaking currently aims to protect the workers and firms who are hit hardest and people employed in informal economy. In particular, temporary transfers and tax reductions were provided for supporting unemployed people. Needless to say that today, the healthcare sector, notably in all countries, requires special financial assistance. The government, mainly and notably in developing countries, of course. The government also introduced tax holidays for the tourism sector, which is a significant generation of inflows, and additionally to the tourism sector, special supporting programs were introduced for agriculture and construction to make sure that, for example, we had a bad experience from 2008 when during the recession, construction sector, many places were just stopped and they were never finished. So we draw very much attention to what happened before, and we took lessons from the past. As a result of such actions, fiscal policy has become more oriented on the social side, and of course it's natural in the situation. However, infrastructure projects still remain in the agenda, and they still are a priority. Capital investments are one of the main determinants of the long-run economic growth in developing countries, and therefore, in order to ensure that in the post-pandemic era, the already increased debt levels remain sustainable, keeping infrastructure projects alive is very vital. When shocks like this, unprecedented shocks, hit the economy, a need for external funding for fiscal and monetary considerations increase. In this regard, Georgia was lucky to have active and existing program supported by International Monetary Fund. And why this is important? Because it enabled us to augment the existing program and get external funding facility. Georgia was, in a way, the first, you know that many countries knocked on the door of the IMF, and Georgia was the first country with active program, which got very quickly augmentation of the program. So once you have this umbrella, if there are complications, then additional provision of financial resources is easier than it would have been in other situations. And increasing funding under the IMF program helps implement macroeconomic stabilization measures, and at the same time, you know, they accelerate the mobilization of assistance from other international donors. And the funds allocated by IMF and by other donors have a positive impact on Georgia's international reserves of the National Bank of Georgia. And given the extraordinary circumstances currently facing the economy, part of the reserves are used for interventions on foreign exchange market. But flexibility of exchange rate is still very important, and this is what we are exercising. But due to its impact in this unprecedented situation on inflation, we are more active in foreign exchange market now. We have accumulated reserves before. We are receiving reserves now. This allows us to be more active on the market. Foreign exchange interventions are used to mitigate excessive fluctuations of the national currency and to provide liquidity to the foreign exchange market. At the same time, we have been always advocating, and we have been very active on lari-denominated instruments. And I have to thank BSTDB for siding us very much on this side. I think that all these instruments we have established with organizations like BSTDB before, with EBRD, with IFC, with FMO, are really great use for us. And I think this is also which needs to be taken into account. This needs to continue because these are very important sources, financial resources of the economy. So it cannot be really underestimated. And in the future, of course, crises are never desirable and not anticipated either, but we need to make sure that we have these instruments in our basket. Now let's talk about the region a bit. And there is a need for more regional cooperation in this situation in order that countries have better access to external financing during stress periods. There have been cases, you know, some countries decided to sort of restrict imports, but I think in this situation, it is definitely not helping. I mean, this pandemic shows how bad it is to live in a closed situation and how good it is to cooperate, to have very active trade, to be as open as possible. With this, we established, establishment of swap lines with advanced economy central banks such as ECB or Fed could be efficient sources of financing for the countries. The mutual problem that most of the Black region countries share is a relatively high share of tourism sector in our overall economies. Since the pandemic is expected to depress the hospitality sector the most, and since it is expected to last at least a few years, economic activity going forward may be a challenge in these countries unless some rethinking of the sectoral policy is done. Another thing is increased hurdles in regional trade due to health-related risks and regulations. And of course, these regulations should be there. They need to exist. Otherwise, it may bring negative results in terms of high cases of infected people. Today, we see that supply disruptions make it costly to transport food and other products across borders. And of course, then it translates into higher prices, which is not good for the economy. As I already mentioned, some countries are restricting exports of goods and products, and trade may fall more than currently anticipated. This could disrupt domestic production as well, which of course will be bad for the economy. I think that in this situation, coordination between countries about simplifying the rules for transport companies without hurting the healthcare side, of course, would definitely be helpful for the current situation, as well for the fast recovery in the future. To summarize, on a regional level, our countries need to make sure that we cooperate even more than before, and that globalization will continue to bring benefits. On country level, we have to conduct prudent and counter-cyclical macro policies. We have to make sure that our policies are always prudent, that we always care about stability and about the health of financial sector, because they are always handy. They are always very important. And we have also have to look what are good examples of other countries. These are our neighbor countries or countries. Of course, there are some small countries, bigger countries, countries with some modalities, and what worked in some countries, what did not work in other countries. And we have to try to modify them as much as possible to fit to the circumstances or our economy. And this is what we actually also do. And there are some sources which give information what has been done in other countries, and we analyze them, whether this can be, whether these measures can fit to circumstances of our countries. And we have seen and we have taken examples of other countries as well. I think that Georgia's examples can be also useful for some other countries. So this exchange of information, flow of information in the situation, I think is very important. And our cooperation with international financial institutions, with institutions like BSTDB, I think this is always important, and because we have an opportunity to use experience and professionalism of the staff of these institutions, and last but not least, financial resources of these institutions as well, which is very important to deal with crisis like this. One more issue, which is I think we also have to pay attention. Usually, crises bring up some problems which are in the economy, and we know this, right? And we see much better what are the structural problems in the economy. So while mending the situation, while addressing the situation, current situation, we have to also analyze what was the most vulnerable sides, what were the most vulnerable corners of the economy. And we have to think, we have to rethink what to do in the future with this. Maybe right now it's no time to do full-fledged reforms, but at the same time, analyzing where all this will be unfolding will be definitely helpful for us for the future. And again, crises are never desirable, but they do happen. So we have to make sure that the lessons learned and analysis will be used in the future. So this is what I wanted to say in my introductory speech. I think, again, cooperation among us, among countries, is even more important than it was before, and keeping and implementing prudent counter-cyclical policies in most cases, in monetary, in fiscal area, is always important, and this crisis proved it very well. Thank you very much, and I wish that all of you and your loved ones stay healthy, and I'm happy to stay here with you and participate in discussions. Thank you.
Governor, thank you very, very much for that very rich introduction, just a wealth of topics that you brought in. It begs an immediate question that I have to ask before I turn over to the panelists. Will anyone in the Bank of Georgia be on holiday this summer or not? You are so busy.
Well, we have to wait with holidays. We have been really busy, and because a situation like this prompts us to take actions as soon as possible, but at the same time, we have to make sure that these actions are sound, and communication is also very important. How we communicate, of course, we have to give the truthful information, we have to say what we are doing, but why what we are doing is good. What sector of the economy or the society does it help in? So we have to wait a bit with vacation.
But you have to let them take advantage of the beautiful resorts in Georgia. So we keep that in mind.
Definitely.
Let me
and many of our countries
indeed. Let me start with the panelists. ask them to make a few comments, and for no better reason than the tyranny of the alphabetical order. I'm going to start with Elliot Auckland, Chief Economist at the International Investment Bank. He knows our region very well. He's been an investment fund manager for many years in his home country, the United Kingdom. And he now has been, he's based in Budapest at present with the International Investment Bank, which is the first and only, as far as I know, multilateral development institution that actually moved its headquarters from Moscow to Budapest, to an absolutely lovely location next to the Chain Bridge. Elliot, without further ado, take it over and give us your thoughts.
Okay, thank you very much. Good morning to everyone, and a pleasure to be with you today. I shall split my brief remarks into three areas: a global economic view, focus on Romania and Bulgaria as the two overlaps between IIB and Black Sea. I would exclude Russia, as we have a great speaker on that later. And finally, I'll end up with some areas for multinational development banks to focus on. So starting with the global economy, it's with some confidence that we can say we've passed the worst of the economic destruction of coronavirus, and we're on a path to recovery. We're not quite going to make a V-shaped recovery, as some economic output will be lost forever. But in my view, the global economy will bounce back faster than most expect. First evidence is looking pretty good. Recent data, retail sales in the US and Germany were even up year on year. Chinese economy grew 3% in the second quarter year on year. So why is this the case? The policy response has been enormous, both from fiscal and monetary actors across the globe. We have learned our lesson from the 2008-2009 crisis, namely there was no Lehman Brothers this time, and policymakers were and are willing to do whatever it takes in a short space of time. One simple idea is that the economy has its own productive capacity, which it sometimes goes above, causing inflation, and sometimes below, causing a recession. Currently, we're substantially operating below our potential because of the self-imposed lockdowns. What's key, unlike, say, in a war, is that the economic inputs, capital, labor, technology, have not actually been destroyed. They are temporarily being underutilized. This is something monetary policy can actually fix. After a sharp contraction in global GDP in 2020, we'll face 3 to 4 years of growth well above trend as we return to normal operating levels. That being said, some permanent damage will have occurred. But at the same time, some permanent opportunities will have been created, which won't be enough to offset the damage. We will undoubtedly be worse off, but these opportunities will unleash new growth dynamics that maybe would not have happened as fast if it were not for coronavirus. To give two examples of this. Firstly is the adaptation of technology. Few businessmen and few workers would have gone into the natural experiment of moving their entire business online, at home, digital format. For better or for worse, this experiment has now been conducted by force. Now, many businesses will return to normal in the future, but also many will see that this experiment has shown there are cheaper and more productive ways to run some businesses. Elsewhere, consumers have got used to the buy online, home delivery method. In short, adaptation of the digital economy has sped up, and this will boost long-term productivity growth. Secondly, another interesting change has been on the economic political level in Europe. Many economists have long said that two key things need to happen in Europe, which would make a new era of economic prosperity in the European project. These are fiscal consolidation, or even unification, and a reduction in surplus imbalances, namely that Germany needs to spend more on both the consumer and fiscal level. For the time being, it appears that these dynamics have been unleashed, at least in part in response to COVID. I'm very hopeful that the EU will pass a comprehensive recovery fund, and this will greatly add to the growth potential of Europe over the next 5 to 10 years. Of course, other economic trends have been set in motion or exacerbated that need urgently to be addressed. Debt burdens will reach record peacetime levels, and this will require a new approach to fiscal policy. This is even more the case because of the continued deterioration in inequality. In short, the social contract has to be rewritten, and it is likely to be in a world of higher taxes, particularly on the multinational sector and on the rich. One way most countries have chosen to deal with this debt is through central bank financing. And this will have long-term consequences of seriously weakening central bank independence. This has also occurred as central banks have used increasingly unorthodox monetary tools, which make them an even more deeply ingrained stakeholder and policymaker, not only in the economy, but in politics. Many countries must walk a very fine line between alleviating debt burdens through central bank action and causing long-term economic damage through excess monetization and a loss of central bank credibility. A world of inflation may not be that far away. Moving to economic developments in Romania and Bulgaria, we estimate that after growing by around 4% in 2019, Romania and Bulgaria will contract by around 5 and 6% respectively in 2020. That is a slight outperformance by Romania versus Bulgaria, which, although is a severe contraction, will be far better than almost all other European economies. What is crucial for both Romania and Bulgaria is their low levels of government debt to GDP, at around 45 and 25% respectively this year. This compares to around 100% debt to GDP for Eurozone countries. Low debt levels mean that governments can go the extra mile and truly fulfill the whatever it takes philosophy to ensure a smooth transition through this crisis. Furthermore, the very aggressive support action by global central banks through quantitative easing and availability of swap lines means that there is a golden opportunity for Eastern European governments to splash the cash without having to worry too much about the impact on interest rates or exchange rates. A strong fiscal approach, which is underway in both countries, will help GDP recover to around 5% growth in 2021 and even 2022. Of course, EU funds will play a very key role in that. Fundamentally, Romania and Bulgaria are very competitive. Hourly labor costs are 4 times lower than the EU average, making the region an extremely attractive place for global corporates to invest in an EU supply chain. Here, the government needs to focus on projects that will bring large spillover effects. A key area is transport, roads, rails, ports, airports, and utility infrastructure, water, heating, electricity, internet. These bottlenecks are what stop multinationals from investing, typically in lower labor cost countries as opposed to high labor cost countries. My biggest worry for the region is in relation to tourism, in particular for Bulgaria. It plays a crucial role in the GDP and exports, about 12% of both. Tourism, unfortunately, is unlikely to be one of the areas which goes through a V-shaped recovery. In fact, it may take as much as 5 years to reach 2019 levels. And it is quite likely this could cause a permanent and significant regional imbalance in the Bulgarian economy. The Bulgarian government should look to invest heavily in the tourism-dependent regions, but in sectors which are not related to tourism. So diversification is desperately needed on a local level. Finally, what can development banks focus on? In the interest of time, I will just focus in name on a couple of areas. Smaller multinational development banks need to team together to use capital and resources more efficiently. All of IIB, Black Sea Trade Development Bank, Eurasian Development Bank are beginning to face capital constraints with rating agencies who are a de facto regulator. We can work together to come up with ways to maximize our capital further. One way would be sharing risks on clients through cross guarantees or partial portfolio swapping in order to reduce concentrations and increase diversification. This is a positive impact, for instance, on the S&P capital ratio. Another way to team together would be to pool resources, including people, financial and risk systems, and even real estate. This could create both financial savings and deeper knowledge and products. This perhaps could not only be limited to MDBs, multilateral development banks, but also regional national development banks. Duplicating resources not only adds to costs, but may also lead to suboptimal decision making. In terms of what we can add, in terms of products, I think there is a great need for equity investment across the region. Ultra easy monetary policy has by and large made debt obtainable for almost all in the region. Although there are still issues in the very long-term funding, 10-year plus region where MDBs are and will continue to play a very crucial role. Where MDBs ultimately can get more bang for their buck is by increasing equity investments. And this is yet another product which I think MDBs can team together to make this in a capital efficient manner. I'll stop there with my opening remarks and thank you very much for the time.
Thank you very much, Elliot. From Budapest, we will go to Istanbul now. I'd like to ask Ms. Ebru Barutçu Gökdenizler, who is the first Deputy Secretary General of the Organization of the Black Sea Economic Cooperation, to make a few remarks. Just by way of introduction, let me say that she's been appointed there by the Turkish government. She has a distinguished career in the Turkish Foreign Service as a diplomat for many years. We'd love to hear what the Black Sea Economic Cooperation, which is an affiliated body, I should note, of both the Black Sea Trade and Development Bank and the International Center for Black Sea Studies, and share some thoughts about the region and regional cooperation. Ebru?
Well, thank you very much for this opportunity to join your webinar today. And I'd also like to say good morning to all the other panelists that are here with us this morning. I would like, first of all, to maybe just give a little bit of background information on who we are as the BSEC. I would like to say that BSEC is actually lies at the very heart of regional economic cooperation in the wider Black Sea region, with the aim, with the objective of promoting peace, stability, and prosperity in this region. As most of you may know, our organization was initially launched in 1992 in the environment that was the favorable environment that was generated with the post-Cold War period. In 1999, we became a full-fledged international organization. And in fact, we will be commemorating our 30th anniversary in the year 2022. Having said that, I can say that during this period, the organization has built a very strong institutional framework of cooperation that covers many areas of mutual benefit for our 12 member states, which we hope will be expanding soon with the inclusion of North Macedonia in the coming period. We have also increasingly become a, how can I say, a project-oriented organization over the years. And having said that, I want to now refer to the pandemic itself. I think that in international literature, it's become quite common, you know, to speak about the growing threat of new and unconventional security threats to the international community. And we've been talking about this for many years, but oddly enough, I think this coronavirus pandemic caught us all off guard. The entire international community was caught off guard. And we have all been trying to adjust to this new reality that we are confronted with. As the BSEC, we feel that we are in fact the only full-fledged regional organization in this region with the capacity, with the accumulated experience and the knowledge to serve at the core of regional cooperation to help overcome the adverse effects of the coronavirus pandemic. What did we do? We were located here in Istanbul, in Turkey. We felt the effects, let's say, as the BSEC Permis, the effects of the coronavirus pandemic somewhat later. I can say that it was about mid-March that that the Turkish authorities, our host country, announced the first cases of the coronavirus here in Turkey. And soon after, the BSEC Permis, Permanent International Secretariat, we also had to close, so to speak, close shop temporarily and go and work home office, which became the sort of general trend worldwide. And during this period, of course, we didn't sit idly, but we did reach out to our member states to see how we could help mitigate the negative adverse effects of this pandemic on our member states. And in this respect, I'd like to say that it was already mentioned, two areas, I think two very prominent areas where I think all countries globally and also, of course, our member states have felt the impact most has been in the sectors of tourism and also the sector of transport and trade and transport, let's say. So one initiative that we took immediately was to host two important meetings of our working groups One was the working group on tourism. I incidentally might want to mention that, of course, we have a wide range of issues that we deal with, you know, that cover agriculture, banking and finance, combating organized crime, culture, custom matters, energy, emergency assistance, environmental protection, IT, healthcare and pharmaceutics, SMEs, tourism, trade and economic development, transport. You know, this is just to mention a few of the areas where we have cooperation among our member states. But as I said, one of the initiatives we took was to host a meeting of the working group on tourism. This proved to be quite useful because it gave the member states an opportunity to discuss the negative impact that it was having on their economies in terms of the negative effect, adverse effect on tourism, which is a very important source of revenue for the economies of all our member states. This proved to be very fruitful discussion, and also we were able to come up with the idea of we also had the participation of the World Tourism Organization, which is a sectoral dialogue partner of BSEC. And together we decided that we would come up with a set of what I can call coronavirus protocols. So we hope to have another meeting in September. We will establish an ad hoc working group to elaborate such protocols, with also, of course, the participation and contributions of the World Tourism Organization. In follow-up on this, on the question of tourism, another meeting that we just hosted this week actually was regarding the Blue Med project, which is a Mediterranean project, let's say, dealing with the protection, preservation and touristic promotion of natural underwater natural and cultural heritage. And the idea is to promote this concept also in the Black Sea region. So we just held a workshop, or let me say a working meeting on that issue as well, to see how we could further promote this concept for tourism in the Black Sea region. Another meeting that we hosted as the Secretariat, as I alluded to, was the Steering Committee on facilitation of road transport of goods in the Black Sea region. This was also, of course, a very useful meeting for member states to come together and to discuss the, the impact that this pandemic has had on trade and transport in our region. As it was mentioned earlier, the first initial reaction of many countries was to sort of lock down. But as time progressed, I think we have all seen that, this is not the way to go. We need international cooperation, and we need to continue to keep these lifelines open. And so this steering committee also provided a good opportunity for us to exchange views on measures that can be implemented to facilitate road transport of goods and to keep the free flow of trade moving. In this connection, we had a list that was submitted by the International Road Transport Union and the BSEC Union for Road Transport Associations. They provided us with a list of urgent and also feasible requests and some project proposals that would also help to resume trade flows, safely and securely. And there are a number of projects there that we would be also eager to find, sources of financing for, which might be something I would like to discuss also later about our relationship with the Black Sea Trade and Development Bank, which, as was mentioned, is a related body of BSEC. I think these are the general comments that I would like to make at this stage, and then maybe I can later also elaborate further on a number of other projects, especially in the blue economy area that we are engaged in. So thank you very much.
Thank you, Ebru. Without further ado, let's go to Kiev, where we're lucky to have with us today Ms. Lena Kosharny. She's the founding, currently I should say, because she's been in Ukraine for many years and has been extraordinarily active in a wide range of affairs. Currently, she is the CEO and founding partner of Horizon Capital, which is a leading private equity firm with over 850 million in assets active in Ukraine and in Moldova, I believe, as well. And also recently, and this should be noted, she was recently recognized and awarded by the online publication emergingeurope.com as a female business leader in 2020. Congratulations, Lena, on this great honor, and please take it over.
Thank you very much. It truly is an honor to be part of this distinguished panel. I'm delighted to communicate to you what's happening on the ground in Ukraine and Moldova post the COVID-19. Well, we're not through it yet, but given the circumstances of the COVID-19 pandemic. First, a little bit of context. Obviously, Horizon Capital, we're the leading private equity firm, and our focus is equity investing. So we initially had our start managing US government money, 150 million, then raised 700 million from US, European investors, mainly EBRD, IFC, Proparco, DG, FMO, IFU, US and European pension funds, endowments, family offices, etc. So all told, we've invested over 750 million in Ukraine and Moldova, in over 150 companies that employ 50,000 people. So let's start with Ukraine. And starting off the year, everyone was very bullish. Ukraine's GDP growth had been 3.2%, was expected to be 3.7%, and on the back of very strong macroeconomic stability over the past few years. So if the rest of the world was talking about 2008 crisis as the last crisis, of course, in Ukraine, we've been through crisis from 2014-15 and underwent a full banking sector reform with almost 100 banks that were closed, that were liquidated, going through very tough austerity measures backed by IMF, bilateral partners. So the country was, let's just say, lean, mean, and in a decent position for what was to come. So with COVID-19 hitting the country, of course, implemented very strict draconian measures, closing airports, closing borders, very strict lockdown, which had to be eased in May for economic reasons. So clearly, Ukraine does not have the same fiscal measures that our neighbors do. The country has invested or spent about 2.3% of GDP for fiscal stimulus, about 3.4 billion. And that's mainly stabilization fund, payments to pensioners, that's $1 billion earmarked for SMEs. At the same time, if we look at our neighbors, Poland, 15% of GDP, Georgia, also high percentage, Turkey, 5%. Ukraine would have to spend 4 to 20 billion in fiscal stimulus in order to be competitive relative to its neighbors. In terms of the monetary measures, very stable in terms of monetary policy. The rates were cut to 6% in Ukraine. In terms of commercial lending liquidity in the market, I mean, everybody knows that the rates have been extremely high in the country. Corporates have been able to lock in hryvnia-denominated loans at 18 to 20%. That's extremely high, extremely difficult. Those rates are starting to come down, mainly because of the currency swaps. As the governor of Georgia mentioned, we also saw these introduced by the National Bank in May. So now we have multi-currency products that bring the rates down to about 13, 14, but still very high. In terms of support to Ukraine, clearly it was essential that the IMF came through for Ukraine with a 5 billion standby arrangement, 18-month standby arrangement that also unlocked bilateral funding. We have had, of course, in Ukraine, there has been a new government. Everyone's aware we have a new president from last year who won in a landslide, over 73% of the vote, with a full absolute majority in parliament as well. And we've seen various government reshuffles. So in March, right before the COVID crisis, we had a change in the government. Prime Minister Honcharuk was replaced by Prime Minister Shmyhal's government. I don't envy a prime minister who comes in right in the middle of a COVID-19 crisis. So what they've done has been quite strong given the situation. We were also, as everybody knows, we had an issue with the National Bank of Ukraine with the governor resigning, citing political pressure. So all eyes were from the business community on who is the new governor of the National Bank of Ukraine. That question was answered yesterday with appointment by Parliament of Governor Kirill Shevchenko, who is the former chairman of Ukrgazbank. He's viewed positively in the business community. He's viewed as a technocrat, as a banker who knows who's got strong chops. That was passed with 322 votes. So clearly now we're looking to see the continued commitment to inflation targeting, to maintaining macroeconomic stability, and of course the independence of the central bank, which is crucial not only for IMF but for business community in general. Before moving into to Moldova, I do want to say in terms of COVID-19, originally the lockdown was very strict, and as we saw, the public healthcare system was able to cope. You know, there was never a moment when more than 20% of the ICU beds were filled. We have cases in Ukraine about over 50,000 with 1,445 fatalities, sadly, so far. In Moldova, moving over to Moldova, about just over 20,000 cases and 666 fatalities as of the latest information. Again, Moldova has, just as Ukraine, implemented draconian measures. At the same time, needed to loosen those measures in May for economic reasons. In terms of Moldova, Moldova also entered the crisis in strong shape, and I think that's very important for both of these countries. Of course, we were in the business community worried because we were worried about capital controls or significant currency outflows. We did not see that, and I think it could have been much worse. In terms of Moldova, Moldova also eased monetary policy, bringing its base rate down to 3.25%. Fiscal measures, again, not much ability to stimulate the economy, focusing mainly on SMEs, on doing what they can in terms of deregulation, in terms of delaying tax payments, etc. In terms of Moldova, the big issue for Moldova is remittances. You know, remittances fell by about 25%. That drives restaurants, HoReCa, the internal consumption within the country. Neither Ukraine or Moldova are seeing the kind of tourist impact because they aren't tourism-based economies. They're agricultural, commodity, export-driven economies. So that, you know, has not been a factor that we've seen. And in terms of both economies, we do expect to see the growth coming back in 2021, over 4% forecast in both economies. And frankly speaking, if we look at the private sector basically is carrying the load in both countries. So I'm also chair of the American Chamber of Commerce in Ukraine. We did a survey of all of our members, over 600 members. About 50% are continuing to invest. 80% have kept their level of employees. So you're really seeing the burden for the economic hit is felt in the business community, and the business community has risen to the occasion and is doing all that it can in order to ensure that those employees have jobs and that the economic hit is minimized. I've tried to stay under 3 minutes, Panos, so.
You're wonderful, Lena. That was a wonderful presentation. Thank you so much for bringing the private sector and that dimension into it as well, and helping us cover a couple of countries also where I think more attention needs to be focused on the things that are going on. Let me move on to Moscow now, to our next panelist, Mr. Yaroslav Lisovolik. Again, a gentleman with extensive experience in the region, in the international, in the area of international finance, having worked at the IMF and at the Eurasia Development Bank, also with commercial bank, with a number of major commercial financial institutions, and currently the program director for the Valdai Discussion Club in Russia. Yaroslav, please share your thoughts.
Good morning, ladies and gentlemen from Moscow, and thank you very much for this opportunity to deliver to you my views on Russia and the current context. First of all, I think obviously, as has been stated, we're facing an unprecedented crisis, and I think it will have long-term implications for the world economy. In some ways, there may be permanent changes that the world economy may undergo. And I think one of the implications may be, going forward, greater emphasis on reserves and buffers in terms of economic policy. I think another theme that may become important is supply chains, and whether they're nationalized or whether there's a different approach, say, towards regionalization of the supply chains. But certainly there may be efforts to try to limit the degree to which countries are vulnerable with respect to the disintegration of the supply chains. I think with regard to Russia, if you look at the performance so far, and in terms of the forecasts for this and next year, it does seem that probably some of the worst scenarios are, at least so far, not coming to pass. And in terms of the estimates for the GDP dynamics for this year, some of the estimates that we're seeing are in the range of 6 to 7% decline. In terms of the recovery, next year, it may not be as emphatic as in a lot of the other EM economies, but still some recovery is likely to take place next year, probably on the order of 3 to 4%. And then in terms of the main macroeconomic indicators, I think the biggest surprise probably was with regard to the ruble, the fact that it has not depreciated far more significantly, as has been the case in the preceding crisis episodes. And one of the explanations that may be advanced to some degree is the decline in demand and the accompanying significant contraction in imports. And obviously, the fact that the tourist sector was hit significantly was an additional factor. But overall, we're certainly seeing that with the ruble being close to 70, 71 versus the dollar, it is not as weak as was expected. Other indicators in terms of the budget balance, a deficit of around 3% this year, probably around 2% next year, and still significant reserves in the National Wellbeing Fund. That basically means that in terms of the macroeconomic stability, the economy is faring relatively well. With regard to the anti-crisis measures and the anti-crisis response in Russia, I think one of the frequent questions is the scale of the response, especially the fiscal response, overall being estimated on the order of around 5% of GDP, and that is viewed as being significantly lower than in a lot of the other, especially developed economies. And the reasons for that relatively moderate response, relatively moderate fiscal response, may be that Russia is still very much dependent on external factors, including the oil price. And that to some degree means that to some extent it can free ride on some of the stimulus that is taking place from the developed countries such as the US, that in turn is supporting the oil price and has led to a recovery in oil prices. Probably another component may be significant prioritization of macroeconomic stability, probably even to some degree at the expense of growth, and particular emphasis on the need to secure significant reserves. So post-crisis scenario potentially may be that Russia comes out of the crisis with still significant reserves, and currently in the National Well-Being Fund, we're talking about still well more than $100 billion worth of reserves. I think it's also important to note the changes in terms of the anti-crisis response with regard to sectors and time horizons. There was an initial response that was short-term to try to limit the damage for the SME sector, but later on during the next waves of the anti-crisis response, there was more emphasis on the longer-term needs of the economy to support human capital. And also, interestingly, the IT sector is to receive notable support as a way to prop up productivity growth and longer-term growth dynamic. And to complete my intervention very briefly on the role of regional institutions and regional development banks, I think they have a particular role to play at this stage during this particular crisis. Given the fact that there is the belief that the markets, the private sector, to some degree underestimated the importance of certain segments such as human capital development and the healthcare sector. Probably there is scope for the development banks, development institutions to step into this void. And as Elliot has noted in his intervention, I think there's definitely a case for a platform amongst regional development banks, amongst regional institutions to co-finance development projects, given the fact that the scope for these projects is starting to become more significant in view of the greater demand and needs for human capital development. And I think at the global level, there is the case for a more coordinated response from the development institutions, from regional development banks being incorporated more explicitly into the global financial safety net, and for there to be an explicit kind of element, regional layer of development banks being part of the anti-crisis response, an explicit part of the anti-crisis response. I think during the G20 coordinated stimulus exercise, we did not see the regional layer and the regional development banks being singled out explicitly as an important component of this coordinated anti-crisis exercise. So those were some of the key themes I wanted to touch upon. Thank you.
Thank you very much for those excellent points that you raised. Let's go to Athens now, because we are running a little bit behind, unfortunately. Our speaker is Mr. Nikos Vetas. He is the Director General for the Foundation for Economic and Industrial Research. He is also a professor at the Athens University of Economics and Business, widely published, very well known in academic circles in Greece and broader in the region. Please take it over, Nikos.
Thank you very much, and good morning to everybody, especially to the panelists. I listened to all these remarks with great interest. Let me just give you a little bit of the Greek angle, but also talk about the broader picture. And while being brief, I will try to break my remarks in each case, Greece and the world, in two parts, before the current crisis and then what is happening in the current crisis. First of all, a little bit of, as I was listening to all of these remarks and overall during these weeks, a little bit of history comes to my head. Trying to think from the recent past, what we are going through resembles most. And of course, nothing happens twice, but perhaps one optimistic view is if we think of the latter part of the 70s, of the oil crisis, which was again a big hit in the global economy, a direct hit primarily on supply, then on demand, like what is happening now. As we all know, after the big hit in the global economy and in most then Western world, certainly in Europe and the US, there was a little bit of turbulence, there was some inflation, but then we got into the infamous or famous great moderation of continuous growth for about 25 years or so, which was actually carried on top of three things. One was technology progress and incorporating computers into everything. Now we are not going to have computers, but maybe we're going to have other things like in the energy sector. But then there was a second thing, which was increased trade flows, deepening in Europe, South America, incorporation of China and most Asian economies into the global net, and so on and so forth. And this globalization helped a lot. And third, not to be underestimated, political stability. And on top of all that, we managed to overall have to make, I would say, good progress. Then, of course, we hit into an area where we started increasing debt too much to sustain these otherwise unsustainable growth rates. And starting, I guess, about year 2000. But I'm just looking back just to say that it is not for a given that the next decade or so is necessarily going to be a difficult one. I guess there are decisions to be made on the policy front. So now very briefly, in terms of the world economy, there are things, of course, that should worry us all as to how we are entering into this crisis, especially the fact that monetary policy in large parts of the world had to be moving in the area of seriously unconventional for a long time. The way I look at these monetary policy measures, this is like cortisone or other drugs that you have to do when you have to do them. But in the middle and long run, that's not good. And at the time when we were thinking about how we're going to get out of this trap, then we were hit with this. So now, and now rather than using the brakes, we're using the accelerator again. So, we have to very seriously think how we are going to get out of this. And obviously, one of the reasons why monetary policy pre-COVID was moving in that direction was because even though money in large part of the world was at zero cost, investment was actually not moving in a satisfactory manner. And one has to think what's going to happen looking forward. Now, how has the world responded? Okay, maybe a B plus, B minus. This was a new crisis. In retrospect, it would be certainly beneficial to have more collaboration, especially on the healthcare front, and exchange of information. And I do not necessarily mean here China. I mean after the problem got out of China. Even now as we speak, and even within the European Union, there isn't enough common understanding about how to move with respect to especially movement of people. And this does affect, of course, tourism, but it's not only tourism. So it looks like we went back to our instinct, which was everybody goes back to their governments or to their states. Now going back to Greece, as most of you may know, Greece went through a serious crisis of all sorts in the last 10 years. It went through 3 severe programs supported by the European institutions, but also the IMF. The last of those was concluded in 2018. And then a year later, we also had, we lifted limits on bank transactions and basically capital flows. Greece was growing faster than the EU average. And it was actually moving in the right direction in almost most short-term indicators. But it has been hit hard. Now, thinking of the Greek situation, one can say a few good things and a few worrying things. Let me do this in sort of a mixed order. First of all, the response to the healthcare crisis, to the COVID issue, has been viewed by everybody as extremely successful. So how much the virus has spread, the number of deaths was extremely low. The healthcare system actually held well, and the population very much collaborated with all the measures taken. As a result of that, the direct hit to the economy after the lockdown of about 2 months, which actually did not affect the production function in terms of manufacturing. After that, the situation now in Greece is effectively back to normal. But obviously the big question mark is tourism. Tourism is a huge part of the Greek economy. And not only it's a huge part of the Greek economy, but contrary, let's say, to France or to Italy, most of the tourism revenue is highly concentrated in the 3 summer months. So, you know, once we go past August, or rather past September now, there will not be much of an opportunity to recover in terms of revenue. My own expectation is that total revenue is going to come down to about 20%, let's say, of the previous year, when it was somewhere between 18 and 19 billion euros. Just to put things in perspective, the Greek GDP is in the neighborhood of about 180 billion and a little bit more. Now, the reason my estimate is low is because even though there is a big push for people who want to travel to Greece on the aftermath of the successful reaction to the healthcare crisis, most of these people will not be, will tend to be younger. Younger people spend less when they're tourists than, you know, people like 65-year-olds. They're going to be more reserved, and certainly they're going to come with prices that the tourism sector would have to discount. So these are the things for tourism. In some sense, what may be more worrying is not what happens this year, which I think is going to depend also on random factors in large markets for Greek tourism, like Germany, the UK, the US, Italy, and so on and so forth. But the thing is, what's going to happen also in all the other countries for which you talked previously, what's going to happen in the next couple of years and later. In other words, whether this is going to be some sort of a shock that is going to stay with the system longer. In addition to tourism, Greece is actually quite, has a relatively high dependence on transport of all sorts. It's a local hub for the area. It's also a gate, an entrance point for global trade through the Piraeus port, and increasingly more through the Salonika port. Greece is also obviously big, huge in the global shipping industry. So how this is going to go in the next couple of years is going to be important. Now, having said that, the good news are on two fronts. The one is that it looks like there is a plan, both in the local government, the Greek government, but also with European support. There is this crucial EU summit taking place actually just now. And we're going to see what's going to be also the fiscal response in addition to the ECB response. But it was crucial that Europe, in quote, whatever that means, actually decided this time that it is not going to be prudent to increase risks and add another crisis, possibly a debt crisis, on top of the COVID crisis. In that regard, the position of countries like Italy, which also have a high debt burden and have been stagnant for the last couple of decades, is important for what is going to happen to Greece. But basically, the situation is that the problem was and is severe, but the reaction has been thus far serious. And what's going to happen in the next year is not necessarily a negative continuation. For this year, in our institute, which by the way is an independent foundation dealing with the Greek economy and then the broader area in Europe, is that the Greek economy is most likely going to contract in real terms by about 8% this year. It's going to depend. On top of that, you have to add about 1.5% deflation because of energy prices going down, because of demand going down, and also some consumption taxes like VAT in some areas have also decreased. For next year, on top of that, if the situation continues, then I anticipate something like a 5% increase, 5 to 6. So those were my remarks, and happy to contribute more later if you wish.
Thank you very much. Time-wise, we're a little bit compressed, but if our panelists are available and our participants are willing to stay on, we do have a few questions that we may be able to get to. I have one that is kind of general about our plans in case of what plans are there in case of a second wave? Will the economies of the countries resist in front of a new wave of coronavirus? I think that's a concern that's on many people's minds. I don't want to pick on any one particular panelist, but if anyone wants to talk about the second wave and whether we can see a repeat of the lockdowns and we can see a repeat of the measures, and if the measures will be as effective the second time around and all that. Does anyone want to touch on that question?
Well, perhaps very briefly from my side, from Moscow. Just as I said, I think buffers and reserves will be an important part of further responses if there are further waves. I think if we're talking about the Russian economy, the reserves are there, the debt load is low, so there's still fiscal scope to support the economy in case there are further shocks. And in terms of other aspects of responding to the crisis, I think the second round and further rounds of response will be facilitated by the fact that there was significant work that was done in responding to the first wave of the crisis. So in terms of difficult issues like, for example, regional coordination and the role of regions in large countries such as Russia, this experience from the first round will be very important in garnering the response during the second wave.
Great, okay, thank you. Anyone else want to talk about the second wave?
I think I'll quickly add that I don't expect a repeat of lockdowns, as I think we've learned a lot about how to deal with the health of this crisis. And if you look even at the death rates, how they've developed over time, even from a purely medical point of view, we've improved a lot. And that's included, of course, about medical remedies. We're not yet at the stage of a vaccine, but in terms of remedies, there have been a couple of breakthroughs, and it does look as if it's not quite as severe as it was, at least in the early phases, although there could be a number of reasons for that. But I don't think there is the political or economic will almost in any country to repeat the lockdown. Rather, it would be tailored approach. Most likely, unfortunately, in relation to tourism, that might be one area where you'd see continued measures. So a closure of borders continuing and a very quick reaction to that. While in terms of the ability for people to go around, go to shopping malls, etc., I don't expect that type of lockdown to occur, but we could definitely see another closure of borders again.
Okay, just to follow up a little bit, because we heard some very interesting differing perspectives. For instance, we see that in Russia, there's a lot of fiscal space to do things, and there's a confidence that additional measures can be taken if necessary. Lena pointed out the fact that Ukraine faces considerably more constraints. So it would be a little bit more tied up in terms of what it could do and what it could not do. Another point that I think, at least from my perspective, is we've seen how central banks have seemed to have overshadowed everyone else in this process. I don't know if anyone wants to comment on this, but it seems that they are the most trusted institutions right now globally, overshadowing governments in many cases, overshadowing certainly international bodies. It's an interesting situation. How long can it go on for? I've heard some people, there were some comments raised that, maybe it's not sustainable. They may become politicized, especially if there's some monetization that takes place of debt going forward. I don't know if people want to focus on that. Perhaps you, Nikos, given you're also focused on the Greek economy and some of the comments that you made. Would you like to comment on that? Wait. There we go.
Okay, I forgot to unmute myself. On the Greek scale, of course, Greece is part of the Eurozone. So whatever happens to Greek banks is going to reflect to a large extent what happens in Frankfurt. There are also some specific issues that have to do with the treatment of non-performing entities, which while it was progressing, now due to the recession is probably going back a few steps. But your question was more broadly about monetary policy, and what its role and especially its limits. And there, I cannot see how, thinking about the next 4 or 5 years, we cannot avoid some sort of monetization policies, which I'm not sure exactly how is that going to work. But even if you think about the ECB now basically has on its balance sheet a significant part of the European economy. This is not necessarily a situation that is healthy the way it goes. So I'm not ready to say what's going to be the turning point. In some sense, this is going to depend also on deepening policies on other fronts in the Eurozone. and bringing the economy closer. The Eurozone, the monetary policy has been stepping in so much, partly to replace other parts of policy that have not been doing their job. And I mean here not only fiscal, but also in the, on the front of structural reforms. Productivity in Europe and in our entire area has been lagging behind.
So do you think that the ECB is there by default because the others have failed to pull their weight, as the case may be? Or does it just enjoy an endless amount of credibility like the US Fed seems to right now?
I think that the ECB learned its lessons also from the previous crisis, from what was happening back in, let's say, 2009 onwards, and that credibility, you know, starting from Mario Draghi's "whatever it takes," is key. You know, there was some back and forth at the very initial days of this crisis, but basically, what the ECB is trying to do is pull its weight and play a very strong signaling role about how the next years are going to be. That, you know, that nobody is willing to take unnecessary risks. However, the ECB knows that it is dealing with a number of elected governments, and especially at times of recessions and crisis, you never know what voters are doing and what sort of governments are going to vote for. And certainly in a number of countries, from the strongest to the weakest, we can expect on the political front and then on the fiscal front surprises.
Thank you. I have another question about the role of the region. If we can sort of look into a crystal ball going forward. There's this whole talk about shortening supply chains to Western Europe and the Middle East. The fact that the dependence on one major dominant global supplier such as China, people are concerned about that. They're looking into issues of diversification, things like that. We have a number of economies which seem to be in a position to fill this sort of a gap. We have countries, we've seen in Ukraine, for example, not just with grain, but in its industrial sector. Turkey, for sure, they seem to have played quite a prominent role with the medical equipment. Romania and Bulgaria as well. Let me ask Lena, first of all, and then maybe Elliot, if you want to share a few thoughts on that and how you see this region. Will it benefit from this in the longer term, Lena, do you think? Will it create new investment opportunities? You spoke about the private sector driving the growth, which I agree with you very much. That's been very much the case. Do you see it will lead us out of this crisis again as we go forward?
Well, definitely. It will be a positive factor for Ukraine and Moldova. I mean, even if we see what EBRD's chief economist said, Vieta Yavorchik, and she said that as the economy recovers, Central and Eastern Europe could also benefit as European businesses seek to make their supply chains more resilient. And definitely, we see that the region has very high comparative advantages, has an attractive cost base, already has established those export markets. We saw Ukraine pivot towards EU, towards Middle East, other export markets, and we expect that to continue. So definitely we've seen Poland that said it will be the tiger of the East in terms of manufacturing. And certainly if we look at when we entered this crisis, we expected 10 countries worldwide to be in economic decline. Now 170 countries expect economic decline this year, and every single country, every government must be thinking, how do we differentiate ourselves? How do we support exports? How do we ensure that we offer an attractive proposition for foreign direct investment? And I believe that's a question and a challenge for the governments of Ukraine and Moldova, which I know definitely they're looking at. I mean, if we look at the role of the private sector, I want to go back to what Elliot said about equity investment. And we see, obviously we're in a very specific industry. We're in the private equity industry. And when we look at private equity worldwide, there's 1.5 trillion of dry powder. And we do see that in Ukraine. We see regional funds activating their interests. We are the leading player, but we do see that funds are looking because they're looking for assets. They're looking for attractive valuations, attractive opportunities. Right now, if I look at what we have in Moldova and Ukraine, in Moldova, mainly we've got our investment in the #1 bank in Moldova, Moldova Agro Bank, but we're the largest private investor in Moldova. We're #1 glass company. We did the first IPO of a Moldovan company on the Bucharest Stock Exchange in Romania, $100 million IPO. So I do see that you're going to see these export champions emerge in Ukraine, in Moldova. You see them now, and you're going to see the tech, the influence of tech. I mean, these countries are extremely strong from a tech standpoint. We see that everybody's talking about the potential 12 billion IPO, the largest Polish company, and that's their Allegro. That we'll see how that pans out. But definitely, whether it's e-commerce, IT companies, product platforms, outsourcing, definitely this region has a lot to offer from an IT perspective, and we're certainly capitalizing on that. I do want to say that what I see, the role of international financial institutions is really also to come together with equity investors, because obviously this is critical, is both the equity and debt packages. The kinds of opportunities we see in the co-investors that are in our funds, we see that it really does work when we come into a company and we can leverage both of our capital bases and experiences. For example, when we came into the #1 bank in Moldova, it was together with EBRD involved, and we bought really over 40% of that bank. So definitely, I do see that exports, that pivoting supply chains is going to be critical, and I'm excited, actually quite bullish about these markets, especially for private equity investors. It's a great opportunity. We haven't stopped investing. We just announced an investment in an e-commerce platform in 14 European countries that has Ukraine origins. Very exciting story. And we'll be announcing a new investment in the IT tech space very shortly. So definitely export is important. 70% of our new fund is export oriented, 50% is tech. And I think that's an important element of future recovery for these markets.
So if I'll quickly make a couple of points on the monetary policy, and then I'll go over to the manufacturing sort of question. First of all, I just want to say that I think monetary policy has played a really important role. Back in March, April, we were looking at a potential financial crisis. I think the markets were very scary then, and what we have managed to do is ensure there is no financial crisis, there is no debt crisis, which meant that large corporates are not going under, there's confidence in the market, governments can unleash fiscal stimulus. Without the monetary policy tools that have been put in place now, it wouldn't be possible to speak about fiscal stimulus because simply the markets wouldn't have allowed it. So I think what's been different this time versus prior crises is the banking sector in almost every country is incredibly healthy. And this is a very important way for monetary policy mechanism to work. Just wanted to make some comments on that. Moving to manufacturing, I think the region, if we talk about Eastern Europe, was already prior going into this crisis, becoming a manufacturing hub, increasingly a play on Europe, on Germany, and that's obviously going to continue. There is this large de-offshoring theme, and I think that actually benefits the region. I think one of the comments that was mentioned earlier, how we can learn from other countries' examples. I think Hungary has done a fantastic job, who's an IIB, or another country who's not an IIB in the region, in Poland, in the area of manufacturing, supply chain, or someone like Czech Republic as well. And this is where countries like Romania and Bulgaria can learn a lot, try to copy their policy framework and really build a hub, which they are very much on the way of doing. I think one key thing, though, that will need to be done is a focus on clean sources of energy, because obviously these economies in the European Union are related to EU funds, and the future of EU fiscal policy and in general regulatory rules is clean energy. So if you're manufacturing, your industrial base won't have the supporting clean energy there, or reduced coal or carbon energy, then there's a risk that you won't actually be competitive when we start to see the European Union introduce even more regulation in terms of energy use. So it'll be very important, I think, in the energy sphere for Romania and Bulgaria, for instance, to keep an extra focus on decarbonizing their economies. There's still quite a lot of coal present. And as a way of IIB, one of the tools that we've been working on, I think this is reflective of the region over the past couple of years, is actually financing companies outside of the region in terms of their home address, but financing them going into the region. So in our portfolio today, we have a Swedish corporate, we have a Spanish corporate. In our pipeline, we have French, German, Austrian, and we're helping them invest into the region. And an FDI will be a really crucial part of adding value, adding productivity to the region. And this is where I think policymakers can really make a big sort of getting extra bang for your buck, is by finding those types of companies who will bring know-how into the local economy and really allow productivity to move forward. So having a very strategic investors into your local economy. And to be honest, I think that's been happening. It will continue to focus on. And I think if Bulgaria and Romania can learn from the type of policies that were put in place in Hungary and Poland, they will do very well.
Thank you, Elliot. Koba, lots of questions that we could ask you, but just a couple of quick ones. First of all, you spoke about the IMF augmentation that Georgia had done. Another very interesting instrument, which has been used by some of the other countries in the region, is this rapid credit facility of the IMF, which I'm sure you're familiar with. For lack of a better word, has it been successful in your view? Does it lack the stigma, and that's the word that I'm a little bit cautious about using, that other times resorting to the IMF has had for countries? Could you share some thoughts on that? How you've seen how that's rolled out and played out in some of the other, you don't have to necessarily mention specific countries, but the instrument itself and how it's been received and how you see the market also receiving it.
Yeah, thank you for this question. In fact, IMF has diversified its instruments quite a lot, and what happened in 2008, actually after Asian crisis and after 2008 crisis, and it has quite a lot of instruments to help. I think that instruments which have funds, I don't think that there is any stigma, because in this difficult situation when almost all countries needs help, we saw one more how important it is to have an access to financial resources. But I would say even more. Okay, I would say even more. Maybe I'm a bit biased because I'm a former fund staff member, and that having the active program, most likely for developing countries, for checks and balances, for macro stability is very important. Okay, because there are a lot of standby programs. You know, you may not receive financial assistance, but you have reviews, and there is a debt sustainability down, the fiscal sustainability. I think that we have been quite a good example. For example, I mean, we were in the middle of the program. We did not have any. We have been taking just very small amount of our quota from the IMF. But when the situation, when pandemic started, we saw that we needed the help. So I think that overall, okay, if we are doing good things, if countries are doing good macro policies, they think about macro stability, that's always good, but there can be always something unexpected, okay? So having this umbrella is always very helpful, because it does not only enable to draw you money from the IMF, but it also, given that there is a macro stability and prudent macro policies in the country, it enables other donors who have financial resources to also help the country. So I don't think that there is any stigma. I think that the countries need to continue to have right policies, and right policies will be background for receiving financial assistance in these difficult situations. I mean, Ukraine also has been quite a good example, because macro stability, which Ukraine has achieved, it's really remarkable, and the country has implemented a lot of reforms. I mean, I know much more about the banking, financial sector, but these were really, really very great. And again, Ukraine is a good example. Georgia is a very good example.
Thank you. I am told that we're running a bit short on time, and in fact, one of our panelists, Nikos Vetas, has to leave. I want to thank Nikos very much for joining us. I think we have time maybe for one or two more questions. There is one here that we have that I think is a nice sort of closing thing, in that someone asked, looking back to previous crises, usually we've been able to draw some useful lessons from each one. What benefits can we draw from this crisis? Especially with the increased virtual capacity we could gain from improved application of the circular economy. So we've had some people talk about the lessons learned we may get out of this, some of the advances that we've seen, but it's an open question for any one of the panelists. If you wish to comment, what do you think we can learn from this crisis, and what will we see going forward, perhaps?
Just to thank everybody, and apologies, I have to leave, but I have another appointment.
Thank you very much, Nico. Thank you very much.
It was a pleasure and an honor. Thank you.
It was wonderful to have you. Thank you so much. Anyone, or will I have to pick on someone? Please.
Probably, if I may. Can you hear me?
Yes, of course.
Yes, very briefly, I think, and this featured in some of the interventions of the speakers today, I think coordination, greater coordination across borders, probably amongst development institutions as well. I think themes such as the synchronicity of the response, in view of the fact that when there is the risk of disruption with regard to supply chains across borders, you need to think about the response not just at the national level, but at the international level. And I think development banks, regional development banks, have a very important role to play in that regard, in facilitating this synchronicity and facilitating the response at the regional level. So I think that may be one of the themes coming out of the crisis. And quite frankly, I do hope that regional development banks will become a more prominent theme in terms of the anti-crisis response, in terms of policy discussions at the global level after this crisis.
Please, Governor.
Yes, very short response. I think that lessons learned from this crisis will be to make sure to do effective investments in education, in healthcare, and generally in human capital.
Ebru?
Yes, I just want to also add my voice to say that I think one of the major lessons here is that is the relevance of international cooperation and regional cooperation. When we're confronted with the global challenges, we have to have global responses, and we have to coordinate our efforts. So that's why I'm saying that one of the major lessons here is to reinforce regional cooperation and international cooperation. And I think this goes to say that this highlights also the relevance of the Black Sea Economic Cooperation Organization in the period ahead. Thank you.
Great. I think we could go on and on indefinitely, but I'm told that we have sort of maxed out our time available for the presentation today, for this discussion. I want to thank each and every one of the panelists, beginning with Governor Kobak-Venetadze, Elliot Auckland, Lena Kosharny, Ebru Barchu Gökten-Izler, Yaroslav Lisovolik, and of course Nikos Vetas. All of them, a big thank you for being here with us today, giving us the opportunity. What I hope will be the start of a conversation and the start of other webinars that we may have in the future to cover on this and other issues as we go forward. I want to thank the participants. We had a good participation, a number of questions that came in. I want to apologize to the people that we weren't able to get to their questions, unfortunately. We'll try to find ways to improve that as we go forward in the future. Thank you very much to everyone for being here today with us. And I wish, like the governor said earlier, health and safety to everyone and a good summer. Thank you very much.
Okay, thank everybody. I think it was very interesting webinar. Again, thank for optimistic view on international financial institution and the role of IFI. Because frankly speaking, I was a little bit pessimistic about the role of IFI in our region, comparing with strong efforts done by national authority, by central bank. But okay, your view is very valuable, and thank you again for your participation.
Thank you very much. Thank you.
With that, goodbye,
Thank you.
everyone.
Thank you. Have a lovely day, everyone.
Bye-bye.
Bye, thank you.